Hey investors, welcome to the Investor Lab. My name is Goose, and on today's episode, we're going to be talking with Mark Trowell, the CEO of Yabonza. Now, at the moment, anyone who is involved in the property investing space knows that there's some stress, concern, considerations around property management, tenancies, all of that kind of stuff, how to mitigate your risk and how to increase your cash flow. This episode ticks all of those boxes and more. We delve into different strategies and ideas around that. When is it a good time to buy? Why Yabonza does what they do, how that can benefit you as an investor, and most importantly, how to really clarify your perspective on how to optimize your own portfolio as well. I know this episode is going to be massively valuable. This is best suited to really anyone who is currently a landlord, whether that be with one property or more. This is going to be greatly beneficial to you to get some perspectives and insights on how you can navigate this time very well now and also into the future. Now, if you like this content, please like, share, subscribe, tell your loved ones, tell your friends. We really appreciate it, deeply, deeply appreciate it if you can help us spread our message to educate and inspire and transform the wealth creation stories of other property investors as well. So if you want to find out more about how you can work with us directly, how you can join part of our inner circle, then head to theinvestorlab.com.au. There's loads of really great stuff there, resources, access to our online community, and of course, access to us as well. And if there's anything I can do to support you, please reach out and let me know. There's also going to be a link for an opportunity in the show notes to connect with Yabonza. Click on that. Use that link to connect with them and see if they'll benefit you in your property journey too. I hope this has been beneficial. I love you lots. See you on the inside. Hello and welcome. You are listening to the Investor Lab, and joining me on today's podcast, I have a very special guest, Mark Trowell, CEO of Yabonza, one of the fastest growing, most exciting and most disruptive property management companies in the country. And I thought, who better to have a scintillating conversation with about how to leverage property management to benefit your property portfolio, how to navigate the current environment with everything that's going on with the coronavirus, and get another perspective from the other side of the property professional fence. So, Mark, welcome.
Thank you. Thanks for having me.
Mate, it's a real pleasure to have you on board. And, just so everyone knows, Yabonza are a company that we recommend to our clients. Now, the purpose of this podcast is not to be a big ad for Yabonza, but I do want to publicly state that I personally recommend Yabonza. I do actually think they're a great company doing really great things. And in this episode, we're going to be digging into a lot of different topics. We want to, not just talk about what Yabonza is. We want to talk about how property management is changing in Australia. We want to talk about, cash flow, growth. We want to talk about what's happening in the market from both sides of the fence. So I'm sure we're going to have a pretty exciting conversation, Mark.
That'd be good. Looking forward to it.
Mate, I'd love to just crack open the can a little bit. And I have read a little bit about your story. Now, one thing I find a little bit misleading about Yabonza is that it's touted as a prop tech company. But the reality is, and what I see from a user perspective, is that it's not really a prop tech company. It's a property management service that's full service that has people on the ground. And the key differentiation is that you are a little bit more technologically advanced. You use apps and all of that kind of stuff. So how did you get started? Why did you start Yabonza? And why have you defined your brand as a prop tech company?
Yeah, good. Very good questions to start off with. So look, a little bit about my background. I mean, I've been in and around property for 27 years. I did start as a property manager 27 years ago here in Sydney and actually did the same in the UK as well before making the logical leap over to banking and running large-scale technology programs for banks and finding efficiency. So I've always been in and around property and technology itself and combining those two things. More recently, before starting and founding Yabonza, I was actually at Macquarie Bank, and my role there was real estate technology in Macquarie Bank. And I'm not sure if some of your audience know this, but Macquarie is quite big in that space. They bank 40% of real estate agents in the country. And it was really there was looking at how do we find efficiency, great experience for clients. And that's what made me, take the leap out of Macquarie and certainly start looking at that more fundamentally myself and how we can really change that around from what we call a reactive to a proactive approach and something that is, good for the client experience, both landlords and tenants.
Okay. And how have you done that?
So yeah, and what I guess is the second part of your question: why do we brand ourselves as prop tech? Look, we do that because effectively technology is at the core of what we do. We leverage technology for the benefit of what we call taking away the lower value tasks and redeploying people onto what we call higher value tasks. And they are generally the relationship aspects of it. You traditionally, if you look at a traditional agent, you've got a lot of people running around doing these things that a machine can actually do. So why do them? Why not let a machine do those things and then focus on where it is for the value for your clients? Look at property as an asset. How do we then look at property as an asset for our clients? And that's where the real value sits. So it actually enhances the relationship aspect of what we do.
What are some examples of some of those processes? Because, I'd love to get some examples. What are some of those processes that you've been able to automate without? And sorry, I'm not even going to imply that. What have you been able to automate, and how has that impacted the experience of tenants and landlords, good and bad? Don't just give me the good stuff. I want to know where it's actually potentially weaker, whether that matters, all of that kind of stuff as well.
Yeah, no problem. And remember, for us, it's always a continuous development. So we use a lot of data to move from day on day. So what we learn from one day, we apply to the next day, and we continue to develop on what we learn. So that's probably one good underlying thing. So, whilst we've got a lot of automation happening, there's a lot more that we actually step into as well. And if we look at those key areas, and if you actually break down like almost time and motion study around a property manager does, you've got a lot of time spent in repairs and maintenance, issues management. You've got a lot of time spent in payments as well. So if we just look at payments as the first probably example of that, we have our own payment gateway. So we're able to process our own payments. We don't rely on banks to do it. Yes, we use a bank to clear payments, but we own our own payment gateway. And what that actually means is similar to a PayPal or a Stripe. Some people might recognise those brands. We have that internal to our business. That means we're able to actually then take from multiple tenants. You might have one lead tenant or multiple tenants. We're able to take those payments, the rent payments, aggregate that, and then pay to many on the other side without them needing to pay down to a trust account. So we don't receive or hold funds. We facilitate the payment all the way through. That cuts out a lot of the trust accounting work and the reconciliation that goes around on that. Our systems take care of that. It means that there's no risk of us taking into those funds. Our belief here is that the money belongs to the landlord, and that's where it goes. So as the money flows through, it goes out and says, right, management fees are paid, any approved invoices are paid, net funds down to the landlord's external account in one movement from taking the rent from the tenant. So there's sort of the improvements that gain efficiency, but at the same time use that technology again to ensure that there's a better process and again a better outcome for the landlord. And that's one area. Then we can go into the same thing for repairs and maintenance. Another classic example that we look at, right? A lot of people don't realise generally the cost of not really proactively managing repairs and maintenance can cost the landlord. It's actually, we call it like the hidden fee in there. If you look at most things that can be raised by tenants can actually be resolved from tenants. We took a stat from a previous month where we triage everything that comes through. We have facility managers in that stream of work, and 50% of the repairs and maintenance issues that were raised by our tenants in 1 month, we were able to resolve with the tenants. And
wow,
so that's a big saving. You think traditionally someone might have gone, okay, I'm just going to get the electrician around there to have a look at it, when it's just a simple, lights have gone out and you've got to go to the main fuse board and switch that back on, right? You save potentially the landlord $180 plus just in the call-out fees, but also you're creating a good experience for the tenant, because the tenant's going, it's resolved. I feel empowered. I don't have to wait for 12 to 24 hours for someone to come out and fix something. So they're the sort of fundamental things that technology has really creeped into to help create the efficiency. Now, so we have facility managers in there. We have a platform that then takes in all of that, repairs and maintenance issues and queries, and we're able to triage from there. And we enrich any problem that goes before it does need a trade. Then we can get into leasing. So there's a lot of areas that I can break down where what we've done effectively is broken down that whole aspect of the property manager's functionalities, and then use technology to run those components.
Mate, that's pretty good. Now, are you familiar with the terms integrator and visionary? Are you familiar? Okay, so for those who aren't familiar with those terms, there's typically, I guess, two vectors of entrepreneurial leadership. I think is probably the best way to analyze that. One is the visionary, the big idea, and they're going to change the world, and they're going to do this kind of stuff. And the other is the integrator. The integrator is very systems focused, very oriented towards the nuts and bolts and building that together. But very powerful to be an integrator. How do you identify? Because I can see that you've got a big vision here, but you've also got a very systems oriented brain.
I could probably say bipolar.
Nice.
If you talk to my team, that's probably what I'll say. They pull me back from the visionary aspect and pull me back to the reality of the delivery side of things. But yeah, it's a fine line between the two. Yeah, we do have a big vision for this business and where we're gonna take it. But I guess my career in running a lot of large scale technology programs for banks makes you an integrator, right? There's performance criteria there that you've got to. You might have the vision, but if you don't deliver, then it's not worth anything.
Yeah, no, that's good, and that's a really great grounding to have, because I think if you've got the visionary capacity but the integrator skill set, I think that's really good. What is the vision? What is the vision of your company? Or what are you trying to do? What's the big why? Why are you even doing this? Why do you care, for a start?
Well, I care because I was a landlord myself, and I came out from that industry. Look, I think from the beginning, I have always been involved in property. I love property. I love being a tenant. I love being a landlord. I've gained from every one of those experiences, and I do see property as being one of those things that are fundamental to everything that we do in our lives. And what I want to do is make that better. But how do we make it better? How do we make it a better experience for everyone? Because there is so much opportunity that sits within that household itself, right? We've got these landlords out there that have set themselves on a journey of either creating income, capital growth, or maybe the two of them. How do we create a better experience for them? How do we give them something that really benefits them just beyond trying to stick up the rent every 6 to 12 months? How can we make their property a better experience and stand out as well? There's a lot of build to rent coming into the market, so how do you start differentiating property from build to rent? At the same time, look at the tenant experience. How do we create great tenant experience? Because the value in the tenant is also the value in the property.
I couldn't agree more, and I think that is an overlooked part of the equation by a lot of people. And I often talk about. In fact, in my book, I talk about it, and I've done videos about this as well. It's about service. Now, a lot of people don't realize, a lot of investors, property investors, don't realize that what they're operating is a business, and they're providing a service, and they're business owners, and their tenants are their clients. Now, a lot of people don't really join those dots in that way. But if you think about it, that you are a service provider, you're providing the service of an accommodation solution. The tenants are your clients. Then you have a duty to custodianship to generate the optimum experience for your clients, so that you attract better clients, and so that everyone has a better experience, because a healthy business has healthy clients and all of that kind of stuff. And also you have repeat business. Now, what does repeat business look like in property? Well, that would be tenants who stay longer because they have a good experience. They enjoy being there. You get better income stability within your asset, and all of that kind of stuff. It doesn't mean necessarily just, tenant wants a spa, let's go put in a spa or anything like that, right? But it does mean making the experience mutually beneficial, right?
And correct. And for us, the company, if we can distinguish our brand as that, it's benefit for the landlord. Because if you've got tenants out there looking at it going, I could go in with real estate agent A or real estate agent B, or hang on, here's Yabonza down the road there, and I've heard the experience I get by moving into that property. You've instantly got a bias towards that landlord's property because the person you're actually choosing to actually run that for you. And that's an important thing. So we need to create our brand as being that people that can create those great experiences. And there's many, many different ways of doing that for the tenant. And I touched on at the beginning, part of the reason that we do actually own our own payment gateway in our business is because we're able to facilitate the payments for the tenants just beyond the rental. So if you look at a tenant moves into a property, what do they want? They want a good experience. They want a lifestyle. They want their life admin looked after it. So we can facilitate their bill payments, right? One-stop shop. Here it is. Here, we can do all your bill payments for you as well. And that creates that little bit of an edge, starting getting that better experience of how they see that property. And as you said, right, repeat business.
Yeah, 100%. It's very interesting just listening to you say that. So I listen to a lot of podcasts and, I love business as much as I love property and real estate. And I was actually just listening to a podcast last night. I'm not sure if the names are familiar, but it was with Russell Brunson and Roland Frazier. So two pretty prominent figureheads in the business entrepreneur space as well, particularly in the current environment. Roland actually has a massive history in real estate as a real estate entrepreneur. Anyway, they were talking about the thing that creates more exponential growth in any business is simplification, because what people want is the simplest and easiest solution that also meets their needs. Okay. And if the simpler you can make it, it doesn't matter how great your idea is. You go, I'm going to do this, I'm going to do that, it's going to be amazing, and I'll have this, and then this will happen, this will happen, this will happen. But if you could actually just make step A to step, F in one smooth, like nice, easy, user-friendly, simple, and easy to click way, that is what's going to help grow a business. And the reason is because you're going to have greater client satisfaction.
Correct. Seamless. A very, very good example of the taxi versus Uber, right? When you hop out of an Uber, there's no payment to be made. There's no pulling out the credit card or, giving cash across. It's, thank you very much. That was a great trip. Off you go. Seamless experience, right? As you said, simple.
Yeah, I couldn't agree more. Like I love that experience personally, and I think that's a great thing to have as a visionary component of the business. Now, look, let's get stuck into some meat and potatoes, right? Because at the time of recording, and probably for some time yet, let's be realistic, there's a bit of disruption going on. A bit of disruption might be an understatement, but there's obviously the impact of the coronavirus, all of that kind of stuff. There's a lot of negative media about property. There's a lot of stress by investors. There's a lot going on. Emotions are running high. Let me just say that. What do you see from your side of the fence, and how do you think property management can play a role in allaying those concerns?
I think the first thing that we've got to hit on there is communication and transparency. You've got to keep people informed on what's happening. And, you're right. Over this last month, if you look at the number of legislative changes that have come out or the amount of commentaries that come out, it's put people under that uncertainty. Uncertainty in an uncertain environment, people tend to feel more stressed and become more panicked. So the first thing that we identified quite early on is that component. So is to ensure that when something came out, interpret it. What does it mean? What does it mean for the client? What does it mean? And I said talk client broadly, landlord, tenant. So what does it mean for these people? Interpret it, send the communication. So we send quite regular communications around a new piece of legislation comes out or a new piece of commentary is made. How will that impact them? And what does that actually mean for them? So I think that's the first thing that you've got to really latch onto is keeping people informed. So, and the other, I guess the broader aspect, is starting to play out. What does it mean to individuals, the landlord? Okay, so, what are the potential risks? You've got, people asking for rent relief, in the short term. Okay, well, how do we navigate that landscape? How do we navigate the landscape for the landlord? Because the landlord, often more than not has either one or just two investment properties, and they rely on that as potential income, or they're building a future retirement base. So, how do we ensure that we're protecting that for them, and what is available for them as well in the various aspects of it? So you've got to jump on pretty quickly and work your way through that. I think there's a little bit of I was going to say rough ride, but I think there's probably a little bit more to come in terms of that playing out over the next couple of months. I think we've been through probably the worst of it in terms of the initial shock and what does that mean. I think the opening of restrictions coming up over the next fortnight to a month are going to start easing some of that. Hopefully people get back into that normal way of working. But for me, it's the transparency and communication is paramount in any of that. Of helping people through that to relieve stress, anxiety, panic, and all that sort of thing.
Okay, so then tell me, to the 99% of landlords out there at the moment who are freaking out in some way, shape, or form. So for a little bit of context, I recently asked this question inside one of our private groups, and I said, "What are your biggest questions about property management right now?" And I got to say, the response was generally I wouldn't say negative. I would just say emotional. People are like all over the place. Now we rent vests, so we currently rent. We're seeing all kinds of different sides of the fence. So what would you say to the 99% of landlords who are currently asking WTF?
Mm-hmm. Yeah, absolutely. Well, first of all, don't panic, right? There's always a way through this. Remember, property is a long-term journey for a start. And that's the thing they've got to realise is you're not buying for 2 months, you're not buying for 5 months, you're not buying for 6 months, you're not even buying for, generally you don't buy property for a quick 12 months turnover. Property is a long-term journey. So look at it as a long-term gain. Okay, this will sort itself out. I would love to be able to have a crystal ball, but I think, we all know that eventually this has to sort itself out, be it 6 months or even be it 8 months. It will sort itself out. So look at the longer term, look at the longer term, what does this mean for you? It will normalise. We've been through, GFC back in 2008. We saw changes there. We've been through these things in history. Now, if you're buying property for the longer term, it will pan out. It's just, how do we navigate the short term? And what does it mean in the short term? So really look to those things in the short term that are available to us. If you've got a mortgage, you can put the mortgage on freeze. If you've got job seeker available to you or job keeper, look at all these things. Look at all the things that the government's put in place to navigate that short term aspect of it, but knowing that property is a long term investment and it will return, it will come back.
Yeah, no, I agree, and I think it's a challenging time for everyone, and I think that times like these you need to be resourceful and you need to be looking at whatever levers you can pull in whatever kind of ways that you can. I also think it's a really important time for compassion because more than ever you need to go, okay, how can I show love, care, consideration, respect, empathy, all of those kind of things to my clients, to the tenants? How can I lead first with love in this environment? Because I think anyone listening to this would know or realize that right now that's what we need more than anything else, right? We need to be able to love each other through this so that we can all get through it and have a positive experience and work together more than anything. Because at the moment we've got so many things working against us. Right now all we have is each other. And I think that's really
correct. I mean, and if we look at that, so just one of the facts that have actually come out from this last couple of months. So 10% of our portfolio had requested rent relief. So, in that first few weeks, 10% of the portfolio said, I'm putting my hands up, I need help. 10% of our portfolio in the first couple of weeks said, I need help. Yeah, so, okay, so we said, right, we've got to jump on board. How can we help them? How can we be of assistance? So we quickly then said, okay, let's assess where you're up to. Let's see how you've been impacted by this. And let's see what's available to you. At the same time, then let's convey that to the landlord to see what the landlord are able to do. You very much do become that mediation point between the two. As you said, right, they are your clients, so how can we help your clients navigate this through them as well? How can we work collaboratively with them to say, okay, what's available to you? What are the certain things that we can do? Because you don't want to lose a client either. You don't want to go into vacancy periods. You don't want to look at what does it mean in 4 months if you've got no tenant in there. So it's best that you actually both work together and find a solution, because if you can find a short-term solution, it's the longer game that you're playing, and both of you are playing the longer game. So we quickly jump in there to have a look at that.
Yeah, 100%. And I think it's really interesting that you said 10%. Have you seen an increase in rent relief requests out of curiosity since then? Or
10% is what we saw.
10%? Has it gone up since then, or is that sort of where it's at?
The first couple of weeks, it was probably about 2.8%. Yeah. And then there was quite a big jump in sort of week 3, 4. That went up to about 7 or 8%, and then it kind of now plateaued at about that 10%. And we're seeing it now we're seeing the curve flatten out.
Flattening the curve, and that's awesome, mate. That's great. That's really interesting because if you digest it, the problem is, I think at the moment everyone's digesting so much media. Everyone is digesting so much media. Me personally, I've cut my social media usage by about 70%. Just because it's just like
overload.
Oh, it's full on. I don't know about you, mate, but it's like it's full on. I actually don't find it to be a very positive experience right now. But interestingly, that you say 10%, because what the sentiment is that it's much higher. The sentiment, the emotional current would make you feel like it's a way bigger problem than 10%. Now, you've got a fairly decent sized portfolio. We don't need to go into the numbers, but to understand how, like, I think, and also broadly distributed. You're a national service provider, which means you're in different markets. So you'll be able to aggregate that. And I'd say that's a pretty good sample size. Now, interestingly, I recently did I did an interview with Terry Ryder from Hotspotting, and he said that he was talking to, I can't remember which bank, or he was part of a discussion with one of the banks. I don't want to name which one because I can't remember which one it was, but he said that they'd only received 3.9% of their mortgage holders requested a rental mortgage freeze, which, again, if you were to listen to the media, you'd be thinking, oh my God, everyone's like, it's all, going, everything's going into shutdown. But then when you look at these statistics, it tells a very, very different story. I think it's a very promising sign.
Well, it's funny you say that. I was actually talking to one of the mutual banks today, and they said just two clients. Just two clients that asked for putting their mortgages on freeze.
Unreal. I mean, I can speak for ourselves. We haven't put our mortgages on freeze because we haven't needed to, because our tenants are still, all good, safe, secure, and happy. Now, look, I want to navigate from here, because what I think that there's different risk profiles within property as well, because there's obviously many different ways that you can invest in real estate. It's a very dynamic marketplace. I'd love to get your personal insights and perspectives on, yield versus capital growth and some of these kind of discussions, and which you think is the lower risk way to build a portfolio.
Look, I'm a fan. I'm going to be honest with you, and it's probably a hard thing to come. I'm a fan of both yield and capital growth. I think capital growth is the long term. You buy for the long term, so you look at capital growth. You look at yield in the short term to actually then service the property and the mortgage and all that sort of stuff. The short term yield of what you're actually getting there allows you to use that income in other ways. It might help you to build that portfolio and take out various other mortgages and buy other properties. So there is a balance between the two. And it's finding that kind of equilibrium between the two, which means that you've got to have a look at various different areas that are going to, where are the growth areas, where are the yield areas, and often they're not the same place, right? So where are the borderline areas between the two? I'm a firm believer myself personally. I like the balance between the two. I like something that is going to grow over the longer term, because again, my view is you're buying. My view personally is I'm buying for the longer term towards potentially a retirement point of view. So I want that capital growth. By the time you get there, you can actually then potentially liquidate that property or have it as a passive income. So you then use it as a passive income at that point. Then you're looking at, well, actually, I want a decent income on that. I want a decent yield. I want areas that are going to grow in terms of their income aspect. So my personal view is it's a balance. But the other thing I think we've got to think of there is diversification, which I think is really important. And I think you hit the nail on the head before. We've got properties kind of right the way across the country, and the analytics again from that is telling us that areas respond to different shocks in different ways, depending on the industries in those particular areas. So I'm also a big believer of diversification. So where you might have in one area capital growth, you might have in another area you're chasing yield. So you've balanced off between the two.
What do you consider to be good yield?
It depends on the climate, because I think our yield's going to taper off a little bit at me. I think that curve's going to flatten as well. Look, if you can achieve the kind of up to the 5%, I think is a really good yield. I think a good benchmark of yield is what you're borrowing at and your costs around associated with the property. I think that's a good benchmark of yield, right? Mm. So if you can borrow at 2.19%, and you can get yields of 4 or 5%, you're above that, right? You're building fat in that. So that's a good indicator of me, is what your costs are to what you're actually then getting as a return.
Yeah, no, fair enough. I mean, we're massive proponents of both. That is, our whole strategy with our clients is based around 3 core, immutable and unchanging principles: cash flow positive, high growth, and value add potential, the ability to add value in time. And what we're always looking for, and in fact, which is one of the reasons that we recommend you guys to our clients, is net positive cash flow. It doesn't need to be much, but it needs to be net positive cash flow. Now, when you start looking at net positive cash flow, there is no magic number. For some people, if they've got a 90% P&I loan at 3.5% interest, that net positive point, it may be 6.3% gross yield. However, other people, depending on their structures, depending on how all the many different components that make up the operating costs of your real estate business, that net positive cash flow point might be as low as, in my experience, might be as low as 5%. We typically don't go below 5% because we want to make sure that, that's kind of just a barrier line that we set above. But yeah, I think
it's a really interesting point you point out, is that net positive cash flow, because a lot of people just look at the rental income. And a lot of people go, okay, well, that's my income, is my rental income. But you've got to look at the expenses associated with that as well. And where are those hidden costs? And that's why I touched on the R&M before, right? The repairs and maintenance thing. You want to make sure that, yes, you're obviously maintaining your property, but you're not overpaying things you don't need to overpay for. And where are those other bits that you can extract it from? Look at your insurances, look at your mortgages, look at your tax depreciation, if it's available to you there. Look at all of those other things. Look at what you're paying your agent fees. Look at what a potential R&M can be in that property, because they are all factors in terms of, as you said, right, your net positive cash flow.
100%. I'd be very interested to get your perspective as the CEO of a national service provider in the space. How have you seen, now bearing in mind that the coronavirus, situation as it may be, kind of really started back in January. Okay, that was when it was first starting to hit the news. We all kind of knew that there was something coming, and then I think it was around February 20, stock market crash. That was like the it's here. And everyone started to, but really it wasn't until the end of March that on a consumer level, people started going, oh shit. Now, I'd be very interested to know, from your perspective, how have property prices been affected? Because of course, when you affect the revenue stream of any business, real estate included, and that includes tenants and, the whole rental equation. When you affect revenue in any business, it devalues the business. So I'd be very interested to know your perspective on how property prices have been affected in this market.
Well, it comes down to supply and demand. I think that's the biggest thing, right? Supply and demand and affordability. If you look at those things, you bring those into the market. So, if you've got falling rentals, because if you start getting an oversupply, and we've got to look at, okay, what will create an oversupply? What will create an oversupply is people not moving, or, a lot more developments coming online and people not being able to take them up. So you've got to look at then, supply and demand dynamics, which is things like immigration, things like, students coming into the country. And another factor which we've noticed lately is people moving from short-term accommodation, moving their property from short-term accommodation back to long-term accommodation. Right? I think there's circa 90-odd thousand, give or take those numbers, in Australia about short-term accommodation. If you look at, you bring half of that back online, right, into long-term, that really starts lifting up that supply. And if you haven't currently got that big movement of people at the moment, where's that demand going to come from? So it starts going, okay, where's the balance sit? So then you've got pressure on rentals, pressure on yields. If you've got pressure on rentals and pressure on yields, with stock coming on, people are going to go, well, to your point, if I'm doing a calculation, I want to achieve X amount of yield on that, I can't afford to pay that because I can see rental prices falling in a particular area. So I think probably in the circuit, again, this is me personally, I think we're going to see a tapering off the prices in the next kind of 6 months, certainly in certain areas. What I think will be interesting around that is it's not going to be all areas. It's going to be look at the industries that sit within those particular areas as well. Look at, the populations in those areas. So other areas, as I said, our portfolio is quite diverse. So we can see where areas are being impacted more than others. And then that'll be an indicator of property prices in those areas as well in terms of investment properties.
So where are those areas then?
It's areas that are relying heavily on tourism. Yeah. So, if you look at Queensland's quite a big area that relies on tourism. So we're seeing some of those areas where we're seeing a lot more rent relief coming to it. Certain aspects of certain suburbs within certain cities, where you might, again, look at industry types, look at travel, tourism, events, all of those sorts of things. Then look at the general, if you look at the general income of people that sit within those sort of areas, and then what they afford in terms of a weekly rental amount, and where those properties, those weekly rental amounts sit in terms of location to a particular capital city. And they're the areas that you're actually finding the impacts are, because it's people within certain brackets. that are actually hit within that certain areas. And then you relate that then to, as I said, certain pockets of Queensland. So we're seeing very defined pockets of where those sit. Certain areas of particularly Melbourne. We're not finding as many rural areas as much have been hit. It's kind of, I would say, fringe areas.
Yeah, that's a really interesting distinction that you made right then. And this is something that I'm seeing more and more and more and more prevalently. So the types of markets that we invest in, a lot of people, talk about, they don't like the idea of regionals. They think that capitals are the way to go and all that kind of stuff. Great. I'm not discrediting that. Capital cities have got a lot going for them. What I can say from my professional experience right now is that regional markets are way stronger than capitals. Way, way, way stronger than capitals. And I think that if anything, that this current period is going to dispel some myths for a lot of people, because I'm looking at, there's a couple of capital city or nearby capital city areas that we do invest in, typically blue collar areas, not tourism affected, middle to lower middle kind of class areas where the yields are still strong and all of that kind of stuff. But what we're actually seeing in the regionals, the major regionals, is that the prices are actually going up. The vacancy rates are going down still. The vacancy rates are actually still going down. And how you can go down from 0.3% vacancy rate, like keep going down to 0.1. Honestly, one of the areas that we as it stands today, we should have a contract today. The vacancy rate is 0.1%. Now, even if you tripled the amount of vacancies in that area, even if you quadrupled the amount of vacancies in that area, it'd still be a rental crisis, right? So
and basically what you're saying is, what's wrong with that one property in the area that's vacant?
No, no, this is true. It's a great property. It's a great location. I'm very happy with it. But I think the very interesting story coming out of this is the power of decentralization, because I think there's a lot going on there.
I couldn't agree more, and that's kind of what our data is showing us as well, is those regional areas are actually holding up better than those I would call fringe areas.
Yeah, I 100% agree. In fact, there was some recently a very interesting study done by DFA, Digital Finance Analysis, I think if I've got that correct, and they looked at the areas most at risk of mortgage default and mortgage stress. And in almost all of the cases, they were in satellite kind of fringe estate areas. So particularly parts of Melbourne and Sydney where there's big land estates. So there's plenty of supply. The demand's a little lower and their economies are not so diverse, right? So we're talking about those broad acre, those greenfield estates that get established that a lot of people buy into as investments, but then all of a sudden, they've got inherently weak economic kind of frameworks around them, which a little bit off topic, I guess, but I'm very interested to get your perspective. A lot of people talk about investing now. Should they do it? Should they not do it? What kind of things should they be looking to invest in? Now, some people have got the perspective that they're going to be swooping up bargain deals and they should be chasing the 20% offs and the 30% offs and the 50% offs and all of that kind of stuff. In fact, one of my friends at the moment is looking to buy a hotel because he's getting a huge amount of discount on that. But what do you say to people that I've got my perspective, but I'm interested to get yours. What would you say to people that are trying to buy the discount at the moment?
It's interesting. I have a belief here that there's a discount in any market. You've just got to find it, right? You've just got to find the value in any market. So if you're trying to chase a discount right now, well, surely you might find one or two out there. But again, I still hold this long-term view. Look, what do you think that property is going to? If it's a discount now, why is it a discount right now? So why is that particular property? If you're not seeing it across all everywhere, why is that particular property a discount? Understand the value that property is being discounted for and why, and what does that translate into a rental property as well, right? If it's a discount on this side, it could be a discount on the rental side too. So understand why that is a particular discount. And I think you've got to look at the fundamentals of property and why you're actually investing in the property in the first place. And as you point out, right, you've got yield, you've got capital growth. So bring it back to first principles. Whether you're in the market like we're in now, or whether you're in the market, like we might be in 12 months' time, you bring it back to the fundamentals. Invest on the fundamentals, and then that will always carry you through.
Yeah, I couldn't agree more. My perspective is, you don't actually want to be investing in markets where the bottom has dropped out of the market. It's great. It's great to find an awesome deal. And as you said, you can find great deals in any market. But I don't think people should be chasing the declines, because what that says to me is there is an underlying and inherent risk or fracturing or corruption of the fundamentals. And that is not necessarily what is going to do. A good deal is a good deal, but trying to chase the areas that are crashing at the moment, I don't think is a safe and reliable measure. Now, if we can state, and I'm sure we both agree, that cash flow is the lifeblood of any business, and subsequently cash flow is the lifeblood of any property portfolio, what are some ways that landlords right now can increase their cash flow or reduce their risk? What ideas have you got around that?
Increasing their cash flow. Well, I could plug us in there. Come over to us. We have increased cash flow. As I said, we have a efficient fee structure. But you've got to look at it, right? Have you found all of those things on your property that you're eligible to find, right? Have you explored? Look, well, everyone's going through it right now. I did this the other day. This is a good relationship, right? I went through my credit card, and go, what are all these subscriptions I'm paying for here every month? And do I really need them? What benefit is it giving me? Or could I go back to some of these people I'm paying for, and could I find a way to structure that differently? Insurance, for example, I did it with my insurance. And I went in there and restructured my insurance. It saved me quite a bit of money. So you've got to come back and revisit these things on a regular basis. If you kind of just let them sit there, often you might not end up paying the optimal amount for that particular service. Insurance is a good one. Mortgages are a good one. Then have a look at, have you got all the other things on the property? Have you looked at tax depreciation? Is your property eligible for that? Have you looked at your agent as well? Are you getting value for money out of your agent? Look at other things like, what repairs and maintenance are going on in the property. Could potentially you renovate a particular property to actually give, you might have a vacancy period right now. It might be the ultimate time to renovate. If you can add value to that property, if you can add capital value to it, if you can then add something that is more desirable to that property for your clients, as you say, coming into it, these are things to look at.
Yeah, I wholeheartedly agree with that, by the way. And there's a couple of things you touched on there. So depreciation, a lot of people don't think that they think that because their property is not brand new, that they can't depreciate it. We actually, one of the earlier episodes we did of this podcast, we interviewed Mike Mortlock from MCG Quantity Surveyors, great guy. In that episode, I think it's called Unlocking the Hidden Riches in Real Estate and Making Tax Fun, catchy. We talked about how to identify what you can, there is way more that you can depreciate than most people realize. The other thing I think you touched on there is the value add component. Now, when we talk about a Holy Trinity, we talk about, cash flow, growth. The value add potential is, I think, that's your life jacket. Now, a lot of people, when they're buying property, our clients included, they don't want to buy a renovator. They're not looking to be flippers. They're buy and hold investors. And they go, but why do I need to be able to have that weapon up my sleeve to be able to do something like a cosmetic renovation or add a granny flat or something like this? Why bother? Can't I just get a nicer house? Shouldn't I just buy? And these are the times that it becomes super prevalent, because as much as you can buy a property with good yield and you can buy it in an area where you're confident you're going to get growth and all that kind of stuff, there's always the what if. And this time that we're in right now, this economic environment is exactly what the strategy was built around. What happens if everything fails? What happens if vacancy rates go up, employment goes up, and what happens if your best laid plans suddenly get put at risk? Which is why I think it's so important that you've got to have those levers. And as you say, it's a great time if you can do a cosmetic renovation, increase the capital value, increase the desirability for tenants, maybe get better tenants who can pay more, increase your yield on what it was. You may have an opportunity to put a granny flat out the back if the vacancy rates are low enough to be able to support that kind of thing. These are the mechanisms that I believe need to be built into the process in every single property purchase. And if you're not doing that, if you don't have a lever like that, my personal view is that if you're not buying properties that have the ability for you to do something, even if it's minor, you are absolutely just speculating and you're buying a risk.
I mean, I had a property like that some years ago where actually it was just pre-GFC last time. And it was a 2-bedroom, turned it into a 3-bedroom. I was able to go up, put a bigger third bedroom on there, instantly the rent's gone up by 1.5 times.
That's awesome.
Just straight away, just by doing that, because now I'm appealing to a different tenant class as well. I'm able to get people that if someone wanted to share, they could have more people in their sharing. If they were, I could almost extend it into that smaller family range too. So it gave me that scope, and then it increased the yield on the property and increased the income I was actually taking on that property. And if you actually look at it over time, it actually increased the capital value of it too.
Yeah, of course. And I think that's one of the things that people miss, is that when you're doing this kind of stuff, it's increasing the value and the yield, which has on-flow benefits as well. Because if you increase the cash flow and the equity position, then you're able to draw down on that equity much more easily without causing yourself more distress in your day-to-day, in your paycheck allowance of what you can contribute to your property portfolio, because the property is going to support more of that debt, which is a really exciting thing for continuity purposes.
And I think another thing we've seen here as well, in such a low interest rate environment, now's the time to be looking at what am I paying?
Yeah.
And I think that's the thing, you've got a mortgage broker, to go back and start having those conversations with your mortgage broker, have those conversations with your bank. Sorry, you still there? It went blank for a bit. Yeah.
Still
here. Go back and have those conversations with your mortgage broker. Go back and have those conversations with your bank. You might be in a fixing period. You might be, P&I. I don't know whatever your circumstance is. It's always worthwhile checking in on that, doing a health check on those other aspects of those finances. Insurance is another good one. So look at those, because there's money to be saved in those areas.
I couldn't agree more. And look, we've done that personally as well. We've gone through and we actually do it. We do it every month. Every month we go and look through all of the stuff and we go, okay, what payments are coming out? Is this what we need? Do I need it? What's the benefit? Is it nice to have, a need to have? Is there a way that we can do this better, cheaper, more efficiently, better outcomes, all of that kind of stuff? I think taking that view on your property portfolio is essential. Now, I'm mindful of time. What I'd love to get your unvarnished, genuine, and deeply insightful advice to anyone who might be thinking about starting to invest in this environment as well. I'd love to get your perspective on what you see happening and whether it's a good time to actually start investing.
Again, I'll draw back to the time to start investing. I think any time can be a good time to start investing. Look at, first of all, make sure it's right for you as the fundamentals of where your own situation sits. Ensure that it's right for yourself. And again, whole disclaimer in that, seek the right advices from the right people on that sort of thing. But personally, would I come in and invest in this market? I would. I would have a look at this market to invest in. And the reason I say that is, first of all, if you look at the settlement period, if you're buying a property now, how long is that? First of all, you're going to have to, it's a certain amount of time to look, a certain amount of time to find that property, a certain amount of time to settle that property. So you're probably, say, circa, 2 months, 3 months away before you actually get the keys to that property anyway, if you find something tomorrow. And there's, you've got to go through and sort out all the, the banks and all that sort of stuff, make sure you get a deposit. So there's a period of time that will go, bridge under the water kind of thing in the next 3 months. So, I think any time is the right time to always start looking, because you probably will find those gems out there, right? You probably will find those ones where, someone may have gone, I'm just going to sell, or I'm going to move on, or, new development coming into it, or there is going to be something out there, ones that you can actually find, as you said, in the regional areas where you can add capital value to it, you can do those extensions. They will be out there. So, me personally, I think any time is the right time to invest. Providing that is where your journey is up to. Providing you as an individual go, okay, why am I doing this? There's always a question of why am I doing it? Why am I investing? And some people actually go into it quite blindly and go, I just need to buy investment property because my friends bought an investment property, so I need to do the same thing for myself. I'm a big proponent of property. I think property is great, and I think investing in property is good. But understand why you're doing it, because if you understand why you're doing it and what you want to achieve from it, that will help you focus on what you need to do. And so I think in terms of the time to buy, I think pretty much any time is the right time to buy. Apologies.
Oh, good.
My phone played up there again. I'm on my phone, so I get a bit of reception on that. But that's actually one thing I've found lately is there's a lot of stress on the internet network at the moment.
Oh yeah. There's definitely a lot more. As someone who's operating a business from home, it's like sometimes it feels like you're grinding it out like with a peanut grinder. So
and I think some of the internet providers have changed the download speeds as well. They're giving more to the people wanting to watch Netflix at home and less to those people wanting to upload video. So,
Interesting. Interesting.
but yeah, sorry. What was I? Anyway, I guess wrapping that up in summary, I think any time's the right time to buy. Just again, look at your own fundamentals, look at what you're trying to achieve from in the long term, and understand what your investment journey looks like. Because there will be properties out there that you can buy, and there will be properties out there that will rent easily. As you said, look at the vacancy factors in those regional areas you looked at.
Yeah, look, I couldn't agree more, and I think that really plays into another part of our core principles. So we teach people and show people that there are basically three distinct phases in property investing. And there's the foundational stage, which is typical buy $200,000 to $400,000 properties, 5 to 6% yield, etc. Then acceleration phase, which is stuff like granny flat subdivisions, things like that. And then you've got later on stuff which is a bit more like commercials and things like that. But I think without understanding why you're doing it, you have absolutely no idea what the next step needs to be. And therefore it makes it very hard to make the right decision, right? The amount of people that I know who got started on their property investing journey and then didn't really know, like they were just like, okay, I know that I need to do a bunch of stuff and I've got some good ideas and whatever. And then they go out and buy a development site, but then they haven't got the cash flow to be able to support that and all of this, and they get themselves stuck. And so rather than going faster, they end up going slower. They think, I'll just jump ahead to that bit. I'll jump ahead 2 steps. I'm impatient. And then all of a sudden they find that they're stuck there. And then if they'd just done it in a slightly different way and understood the process that they needed to follow to get there, they would have actually had a much smoother ride. So
yeah, and I think you hit the nail on the head with another thing there: education. Get yourself educated.
Yeah.
So, and talk to the people, like yourself, like talk to the people that can help you through that journey as well. And that's really, really super important too. Because there's a lot of material out there, a lot of people out there that can help you through that.
Yeah, absolutely. And that's actually fundamentally why. So we've actually got an online community, a bit of an inner circle called the Investor Lab. So name of the podcast, same group. And the purpose of that group is really to give people access to really deep behind the scenes knowledge, insights, opportunities, all of that kind of stuff. We've got our buyer's agency service. So it's done for you. It's like, yep, cool. Let's go buy your property. Wonderful. Let's help you build a portfolio. But there are people out there who want to learn and grow. And that's why we started the Investor Lab online community as well. But that's for another point. Mark, it has been amazing having you on. I think you've really helped shed some great insights, particularly on property management and how people can navigate this kind of market at the moment. So I really appreciate your time. Is there anything else you want to say before we wrap up?
Look, all I'd say to people, hang in there. Anyone out there who is worried or is panicked, hang in there. We will get through this. It's only going to be a short-term thing, be it 6 to 12 months. Look at the longer-term view of the property. Reach out to those people that, can help you navigate that journey. If you've got good property managers in place, if you've got good, you said you've got investment communities, talk to those people. There's a good statement that was made once, life is too short to learn from all your own mistakes, so learn from the mistakes of others.
I couldn't agree more.
And that's what those forums are for, because there are support networks of people out there to help you on that journey and help you navigate through what you've got. So anyone out there, stay positive. This is only just a short-term thing.
Awesome. Great stuff. Now, for anyone looking to leverage the benefits of using Yabonza, I will have a link in the show notes so you'll be able to click through and gain access to some, amazing opportunities with these guys, which will also help increase your net cash flow position and bolster your portfolio, reduce your risk, which is very important in this environment. Mark, thanks so much for your time. I've really appreciated the conversation. Let's do it again. Let's check in a couple of months and look forward to speaking to you soon.